Hey guys, welcome to this video. My name's Niall and today we're going to be talking about all things dividends. You've probably heard the expression when you were growing up that something has paid off dividends, and usually it'll be something to do with putting in time, effort or investment now to then reap these dividends at a later date. So I'm going to walk you through step by step what dividends are, how you can earn them, and some of the basic terminology and things to sort of look out for whenever you're considering investing in dividend producing shares. So first things first, what is a dividend? A dividend is a sum of money paid regularly by a company to its shareholders out of its profits or cash reserves. So that means if you're a shareholder of a company and that company pays a dividend, you will receive that dividend for every share that you own. Now, not all companies are required to pay dividends. However, in general, the companies that do are those that have been around for many years, and they're typically financially stable. They have reliable cash flow in their balance sheet. But those that don't pay dividends usually instead choose to reinvest the money back into the company in order to grow and fund their future plans. So if we take Amazon as an example, so far in their history, they have never paid a dividend, but they've chosen instead to reinvest that money that would have been paid out back into growth opportunities. So let's move on to when dividends are paid. Now, the majority of companies pay out 4 times a year, so once per quarter. Other companies pay a monthly dividend, as well as others who pay biannually, so twice a year, or else others that just pay once a year. So if we take Coca Cola as an example, they've been paying a dividend to their shareholders since 1970. So if we take a look at their last year, 2018, they paid a quarterly dividend in April, July, October and December, and each of those payments was 39 cents. So total annual dividend of $1.56. So say you own 10 shares throughout that year, you would have received a total of $15.60 in dividends. And for those quarters, there's kind of particular dates that are important to be aware of. So the first is the declaration date, and this is the date that the dividend is announced by the board of directors of the company. Next we have what's called the ex-dividend date, and that is if you buy a share before that date, you'll receive the dividend. However, if you buy on or after the ex-dividend date, you won't receive a dividend. And then the final important date is obviously the payment date, and that's just when the actual cash payment is paid out to the shareholders. So let's look at Coca-Cola's latest dividend payout, which was December of last year, 2018. The company declared on the 18th of October that it would be paying a dividend of 39 cents for the quarter. The ex-dividend date was the 29th of November. So if you own Coca-Cola shares before this date, you would then receive the dividends for the quarter. But if you bought on or after the 29th of November, you wouldn't receive the dividend. The payout was then the 14th of December, and that was 39 cents, and that'll be paid into your brokerage account. Now, in general, there's kind of 2 ways I go about finding when companies pay a dividend. The first is I just go on to Google, I type in Coca-Cola dividend history, I then scroll down and look for the Nasdaq website. I found their site to be pretty reliable and useful to check out other financial information as well as obviously the dividend history. And then the other method I'll use is to go onto the actual company's website and find a section that's usually called something to the effect of investor relations. Companies generally have a full history of dividend payouts, as well as annual reports and other useful reading material on their websites. There's a couple of metrics and terms that are useful to understand when it comes to dividend investing. One of them is the dividend yield. Now, this is basically a percentage which can be calculated by taking the total annual dividend amount that has been paid out over the past year divided by the share price of the company at that particular time. So again, if we look at Coca-Cola for the year 2018, as we mentioned earlier, they paid out a total annual dividend per share of $1.56. The share price fluctuated throughout the year between a price of sort of $40 and $50. So if we say on average $45, then to calculate the dividend yield based on these amounts, we divide $1.56 by 45, multiply it by 100, and then that gets you a dividend yield of 3.47%. It's important to note that technically the dividend yield is always changing. It's based on the current share price. So if the Coca-Cola share price suddenly dropped by $5 to say $40, this would then increase the yield because it's a lower amount that you're dividing into. Hopefully that makes sense. Another quick tip that I personally have found useful is to go onto Google and search Coca-Cola share price. This then brings up a chart of the share price for that day, and underneath the chart you'll notice some metrics, and you'll see div yield and the dividend yield percentage beside it. And this gives an accurate view of the current dividend yield that you can expect if you bought a share, at the current price. In general, most companies have a dividend yield of between 2 and 5%. Apple, for example, has a yield of 1.8%. Procter & Gamble, they've got 3.1%, and McDonald's 2.55%. And it's important not to be deceived by a high dividend yield. Just because a dividend yield is extremely high, 10 or 20%, does not mean that that company is performing extremely well. In most cases, it can actually indicate that there may be trouble under the surface. A dividend can be decreased at any time, or even worse, it can be cut completely. So it's important not to just invest, into a share for a handsome dividend payout, but you should consider and research the company as a whole and make sure it's financially stable and performing well. Another important metric is what's known as the dividend payout ratio. This is the ratio of the total amount of dividends paid out to shareholders relative to the net income of a company. It's basically the percentage of earnings that are paid to shareholders in dividends. The amount that is not paid to shareholders is then retained by the company to pay off debt or to reinvest in core operations. Apple only started paying a dividend in 2012 because they had so much cash on their balance sheet that it would then sort of be hard to justify not paying it to shareholders. If a payout ratio is over 100%, this means a company is paying more dividends out than it's actually bringing in cash. So why invest in dividend shares? Well, like I mentioned earlier, companies who have paid dividends for many years are usually, but not always, financially stable and growing companies. They're popular among investors who are close to retirement, or else long-term investors who are hoping to receive dividends for many years to come, and also usually hoping that the dividend increases over time as well. So because the share prices of dividend paying companies are typically quite stable, they don't really make for short-term trading or investing, since there's very little volatility in the share price. One of the other benefits of investing in dividend shares is what I like to call the dividend sweet spot. This is basically the point where you hold enough shares in a certain company or certain companies that pay you enough dividends that then allow you to purchase additional shares with those dividends. So say you held 30 shares of Coca-Cola in 2018. At the end of the year, you'd have received $46 roughly, which is around the same price as a share in Coca-Cola. So you could then purchase an additional share, which would mean in 2019 you'd be receiving more dividends. This is kind of what's known as the power of compounding, which is basically when you reinvest what you've earned to earn more and then keep reinvesting in a sort of snowball effect. So where do you start in terms of finding companies who pay dividends? Well, there's a few groups of kind of all-star companies when it comes to paying and increasing dividends. The first group is known as the Dividend Aristocrats. Now there's certain criteria to be a part of this group. You have to be a company in the S&P 500. That's the largest 500 companies in America by market capitalization. You then also have to have 25 or more consecutive years of dividend increases. And you also have to meet certain other size and liquidity requirements. And I think at the minute there's actually 56 companies that are classed as Dividend Aristocrats. I think there's 4 new companies added last month. That was Chubb, Caterpillar, People's United Financial and United Technologies. There's then also another group which is sort of step up from that Dividend Aristocrat group, and these are what's called Dividend Kings. These are companies with 50 or more consecutive years of dividend increases, and these include the likes of Johnson & Johnson, Coca Cola, Procter & Gamble. So that's going to wrap up this video on dividend investing. I hope you found it helpful and valuable. If you did, please hit that like button and subscribe to my channel for future videos. Let me know what you thought in the comments below, and I'll also link up some of the websites and resources that I've mentioned throughout the video. Hopefully that'll help you out. So thanks for watching this video and have a great day.